fund managers during these sessions, please submit these in the Q&A function and we will ask them when we get to the appropriate time. I'd now like to hand over to Adrian.
Thanks, Matthew. Thanks very much for attending. I've got some slides that will give you an idea of how the Aberdeen experience, specifically with the Asia Dragon Trust, has been with the rising interest in ESG factors. I think what is really useful is that we didn't have a name for this as we considered these issues part of our process a long time ago. The Dragon Trust has been investing in the Asian markets for over 2 decades now. And Aberdeen as a house has been investing in Asia for since the early 90s. But since as early as 92, we've already had a corporate governance team in Asia that looked at these issues as we pick stocks and analyze companies. It is really important here for us as we take into account these ESG factors, as we weigh broadly what we would like to see from our companies. We're looking for effectively quality issues, things that we think will give these companies an advantage, a sustainable advantage over the competition. And we've done that for quite a few years now. This slide shares with you some of the key milestones that we've had while approaching this topic, but it has been one of evolution rather than revolution. So in 92, when we looked into the governance issues, the question we're trying to answer is effectively, do we trust these companies to take care of the capital that we as minority shareholders place with them? We want them to hold themselves accountable to their board, to their shareholders, and to assess that, we meet up with these companies, we pour through their financial statements and disclosures, and we look at all these things that effectively give us evidence on whether we have a decent degree of trust in these companies or not. I would like to sorry. Sorry, I'm not quite sure whether you're hearing me loud and clear or not. Is this the right? Matthew, can you hear me? I've got some feedback that this is not. Hello?
Adrian?
Yes, hello, Dave.
Hi. Yeah, I can hear you. You're going fine on the presentation. I think it's just that Matt can't hear you, but please carry on for now. We'll sort out Matt's technical problem.
Okay. And Dave, just to understand the format, can I take questions in this 45 minutes, or do I effectively give a presentation and then tackle questions only at the end?
It'll be about, well, the aim is about 25 minutes for your presenting and then the Q&A at the end. But if there are any that come through during, we'll put those up to you as well. Okay,
that's very useful. Thank you very much.
Okay, pass it back to you. Cheers.
Okay, thanks, Dave. Okay, I apologize to the audience. While we iron out some of these things. So what I basically have a 25-30 minute presentation, and then you can post me questions after that, and I'll try to answer that as and when I can. So going back to the Aberdeen experience, so we have effectively been looking at these ESG issues since 92. But what has been the key interesting thing here is that what started out as governance issues have evolved into whether there's enough corporate social responsibility and environmental responsibility on behalf of its shareholders as well. And our approach has been gradually to increase the amount of resource we've put into our themes in Asia and across the other regions as well, and a process of continually educating ourselves to make sure that we are at the forefront of some of the governance, social, and environmental issues that rise up from time to time. So this chart, this timeline gives you a nice view for the progress that we have made over the last 30 years. But it is work in progress. We know it's very thematic at this point in time, but we do believe that understanding and evaluating ESG opportunities and risks form a fundamental part of how we filter, select, and then invest and participate in the companies that we look to find superior returns. The next slide gives you a summary of some of the issues that we find when we look for quality. On this slide, we talk about looking for high quality companies. And what does that mean? For us, high quality companies is not disassociated from evaluating the ESG quality of a stock itself. So we look at the ESG issues. We look for companies with a sustainable competitive advantage. We look for companies that operate in an industry that has attractive characteristics as well. And when we look at the companies themselves, we pay a lot of attention to the annual reports and the financial filings to try and understand how their financial statements are shaped. And we would like to see companies that have a relatively low level of financial risk and are able to execute sustainable returns based on the quality of the products and services they offer their customers. And lastly, the people that pull this together are really important. So we continually assess management quality by looking at their track record, by engaging with them. We do spend a lot of time talking to our companies. We try and talk to them at least twice a year, going through the quarterly statements and understanding the way they invest in their businesses, the way they hope to sustain their competitive advantages against their peer group, and the way they build out and build value for their shareholders over the long term. So effectively looking for leaders in the space that they operate in, and ESG is a fundamental part of of what we're looking for. The next slide gives you a little bit of data on our approach and our resource. We do have a very competitive collection of resources in the Asian region. We have a team of 40 strong across the region in Asia. We're based primarily in Singapore, but we've got offices in Sydney, Hong Kong, Thailand, Kuala Lumpur, as well as Tokyo. And this team of 40 look out and evaluate companies across the region. They are generalist, so effectively but very well versed in ESG issues. And to complement that, we have a team of 3 ESG specialists as well. And what we get from the 3 would be effectively, the 3 would spend a lot of time understanding in deeper sense the issues that sectors and companies go through, and then cross-pollinate these issues with the 40, and collectively we cover and do the research and get the insights for the companies that we invest in. In addition to the 3 hits that we have that are ESG specialists, we also have a team of over 20 ESG specialists as well that reside in the UK that look out for more global trends and issues that we would like to keep abreast of. And these resources mean that for us, we take a very serious view and we prioritize the ESG commitment. It is not to us a cost element. It is something that we genuinely derive alpha from. When we look at ESG issues, it's really important to understand the abilities of the management team, to understand how they're evaluated by the board, to understand how they are measured on their key performance indicators, and then to link it up with how the board has aligned the remuneration of the management team with the interests of the shareholders as well. And that's crucial to our ability to get comfortable and trust the companies that we invest in. Another perception that is that's quite inaccurate is that generally the industry tends to have underdeveloped ESG research and disclosures, and it is quite true across the region. Corporate disclosures in Asia for ESG issues can be found wanting, especially among the small caps and the mid cap space, where companies are smaller and do not quite have the resource to report the kind of information that we would like to see. So we compensate for that by producing our own proprietary ESG research to cover some of these gaps. We do this by we do read third-party ESG reports, but our proprietary team actually covers a wider universe than most of the third-party providers of ESG research and ratings in the region. And when we are able to do that with a team of 43 in the region, we are able to plug in the gaps and cover the inefficiencies of ESG coverage in our investment universe. There's also a perception that ESG standards are lower in Asia, and there is, and this is, I think this was true 10, 20 years back, but it is changing quite quickly. And in some of the sectors, there are leaders in ESG that are emerging across different countries and different sectors as well. For example, we like what Singapore Telecommunications is doing with its ESG team. It's very progressive in putting carbon targets out for telco company. It's also very, it's also has a high conviction on the importance of managing things like data privacy and data security across its group of companies as well. So we like we understand and appreciate that ESG has been a laggard in the region, but over the last 20, 30 years, we have seen a general improvement in the importance of ESG among corporates and investors. And we do see, selectively, we do see leaders within certain verticals as well, with Singtel used as an example for the telecommunication space, where it ranks very highly among global telecom companies as well. The next slide gives you a feel for our research and our coverage within the portfolio. So we've talked about the importance of ESG to our process and our approach, and we've shared the amount of resource that we've invested into this function to make sure that we are well equipped to understand the issues and to evaluate the quality of ESG that we get in our companies. This gives you a slightly different chart. It cuts across at Dragon Trust, and what you get is you get a comparison of the internal rating, which is the lighter blue bar, and the MSCI rating, which is the darker blue bar across our holdings. And here you can see that we actually have, if you look at just the MSCI weights alone, you would see that we actually have a better rating of MSCI ESG across the portfolio than the wider universe. Also, you would see that the way we have set up, we come to our own views as well and our own conclusions as well. And we typically find that in cases where, in this case, for example, we don't hold companies that we think are below average or big laggards within the ESG space. And the reason for the difference of opinion here with MSCI is because MSCI will tend not to rate a company well if it doesn't have levels of disclosure that it can comfortably access. Whereas we take it a step further, and if they don't produce ESG reports, we often go to the companies themselves and ask them for their views and their thoughts and their practice in some of these areas of social and governance importance. So we do engage with the companies beyond what they publish in terms of data and analysis. And that's why we feel comfortable that we have ratings for companies that we feel are above average and above average for a portfolio of companies, which is different to the MSCI ratings. As a result of that, you can see that the portfolio, on the next slide, it gives you a picture of the quality of the Dragon portfolio compared to the benchmark. Can somebody help move on to the next slide? Yes, what we get here is that the Dragon portfolio has a higher ESG rating than the wider benchmark. So Dragon is rated an A, whereas the benchmark has a triple B. And as shared before, we have a higher population of leaders and improvers within our portfolio than the general benchmark. It is important to know here that improvers is quite an interesting term, and it's something that we need to pay attention to, though, because what often also happens is that a rating is often not static, and it is really important to understand whether the company is improving or being quite static in its approach to ESG. You can have companies that start off well but fade in their commitment, and that's not what we're interested in. We want companies to be continually on the lookout to improve their ESG scores, to improve their impact on society and the environment, and to have a high standard for their governance practices within the board and within senior management. So improvers are really important for us. Sometimes you get a situation where a company is not rated highly as is, but have already made investments to make sure that they will improve in the next couple of periods, and that's important to us. On the right side of the chart, there are also some interesting tools that we have used in-house. The top right corner is one where we assess the impact of climate change on the portfolio itself. And what we do see is we run different scenarios, and then we try and get the model, which we have customized from an external vendor, to assess on how favorable the portfolio or unfavorable the portfolio is compared to the benchmark. So what happens here is that this is we have a portfolio ranking of 2%, which means that effectively for the highest probability weighted climate scenario going forward over the next 30, 40 years, the portfolio is in a better position than the benchmark. There are many assumptions that go on behind these models, and it's not a perfect model, but it is a useful tool for us to understand the impact of our portfolio on ESG and to stress test it. So this tool, for example, allows us to also put in scenarios where we change our holdings of the stock and see how that impacts the assessment of the portfolio on ESG factors as well. So it's a useful work in progress. It's not perfect. There's a lot of science behind it, but we use that to sense check our approach and what we see in our portfolio. On the bottom right is another interesting tool that we have internally as well. And here it measures the carbon density of our portfolio against the benchmark. So the second column would show that our carbon density of 213 is actually lower or only 80% of what the benchmark produces in terms of carbon intensity, which is a positive thing. And then the third and the fourth column breaks it off into level 1 or level 2, effectively the impact of direct and indirect emissions on these companies themselves, which also draws a favorable conclusion to our portfolio, meaning that we can conclude that our portfolio's carbon intensity is less burdensome than the benchmark as a whole. We've also have put a case study here to try and illustrate what we're talking about in greater detail, so that you have a greater understanding of what we're doing. We have in the next slide a company called Nari Technology. And what Nari does is that it produces equipment and software which automates power grids across China. It contributes to China's very aggressive carbon neutrality initiative, as it provides equipment and software that will improve the efficiency of renewable resources and the rollout of greener sources of energy within the power grid itself. What we did here was that we looked at some issues that we thought that they could improve on. So we looked at the related party transactions where they didn't have a very good level of disclosure. And we thought that they could improve that to further clarify so that investors can monitor that related party transactions are at arm's length, are fair to minority shareholders and the company, and do not provide an area of leakage of value from the company itself. We also engaged to give them feedback to improve their level of disclosure on greener tech and greener energy opportunities, so that they had some feedback as we engaged as investors to help them improve what they were disclosing and what they were sharing regularly to investors. What happens is that the management has been actually pretty open. Typically, China does not get a good reputation for ESG matters, but we have found that in our experience of engagement that there are pockets of corporates which take ESG issues seriously and want to improve, and Nari is one of these cases as well. So ESG, the management has actually pulled aside and put in resources to establish a new ESG team that would work on disclosing, monitoring, and then enhancing their controls and their checks and balances with respect to related party transactions, as well as they put in the effort to publish an ESG report that gave us a better understanding of the companies themselves. So this would be, this is not rocket science. It takes quite a lot of effort, but it's not overly complicated. There are simple things that can be done to engage with the companies and to make sure that they are improvers in the portfolio, where we hope to be able to add value to them as investors to make sure that their share price performance and the value of the company increases over time. And I realized that I've taken about 30 minutes in. I have some other slides, but I can refer them. We can refer to them as and when that is needed to address some of the questions that might be fielded. So maybe I'll stop here to see whether there are any questions or any issues that the participants would like me to elaborate on or focus on.
Okay, thanks, Adrian. I do have some questions in the sort of question and answer box, and just to sort of reiterate, if anybody has any more, please sort of pop those in. We'll go to those straight away. First one is sort of when you are looking at sort of potential companies for the portfolio, do you check companies sort of within their or supply chain for sort of environmental and social issues? And I guess probably a follow-up question would be governance issues as well.
Yeah, we do. We do have a look at those issues, but we are also bound by resource constraints. We do have a pretty sizable team of 40, but the first layer of test would be to look at the company itself first, and to understand their evaluation of ESG risk that they currently have, to understand the roadmap on where they would like to improve, and then to look out for specific and encourage specific targets that they would like to improve on for their companies themselves. For most companies, having that document approved by the board, signed off by shareholders at the annual meeting, and then implemented in a form of for assessing management performance and delivering management remuneration would be a good start. Increasingly, the better companies would also share with us the level of detail that they get to that they see and encourage among their supply chain as well. And this would cover not just social and environmental issues, but also governance issues as well. There are some realities and limitations to this though. So for example, if you were like TSMC, Taiwan Semiconductor, where you are a big company in Taiwan, you are a very important, crucial part of the whole technology ecosystem in Taiwan. You can demand that of all your suppliers, and they will eventually come up with a plan. They will, they will improve. They will share with you what their plans are. But if you're a small supplier and you're beholden to a large company for your supplies, you can ask them to improve, but they will decide, because there is much less bargaining power there. So within the realities of the market space, we have to recognize some of these limitations. But we work with the companies and we try and make sure that within the situation they are in, they are pushing the envelope and trying their best to improve ESG commitments, not just for themselves, but within their ecosystems as well. And that includes suppliers, customers much less so, because as a customer you have far more control of which suppliers you want to ignore. So that's a slightly different thing.
Okay, thanks for that. Second question. There was a period when you were underperforming because you didn't hold stocks like Tencent and Alibaba on governance grounds. What sort of changed in the makeup of those companies, and perhaps your process as well, that allowed you to get comfortable with them?
Okay. We didn't initially. We've been looking at Tencent for a long time and Baba for a long time now. About 4 years. You're right. We didn't invest in them until about 3 years back. It wasn't only on governance grounds though. There were 3 broad areas that we didn't feel comfortable with. One is we didn't like the VIE structure, which is effectively a participatory note where foreign investors don't necessarily have legal rights to the economic value and the legal value of the shares that they hold, because there's a holding company layer that removes you from that interest, which you don't get in any other markets. So that was a governance issue for us. The second thing was that there was a huge concentration in one or two cash flow streams, revenue streams. So what you had is relatively large companies, but when you look into the economics of their segmental reporting, you find that it's actually one or two streams that make up 80–90% of their business. And many of the other things that they were participating in or they were active in were loss-making. So we weren't quite comfortable with that level of concentration risk. The third issue is valuations, where valuations were steadily coming down, book multiples and earning multiples were coming down, but they were still trading at about 40–50 times PE, which we felt that was a little bit too demanding for the kind of return profile and risk profile that they provided. About 3–4 years back, when we initiated Tencent, and then 1–2 years back when we initiated Baba, some of these things have evolved to quite a different level. When we initiated Tencent, it was trading close to 30 times PE, so valuations have come off quite a bit. The VIE structure was far more established by then. So we were engaging with the regulators in China, and we were getting a lot of signals that this is something that the Chinese government would evolve over time, but wouldn't trigger off a situation where it would compromise the interests of foreign VIE shareholders. So we had some comfort there as well. But it was also important that during that time, we had been following Tencent very closely, and we like the way they treat minority shareholders. It's a huge company, but whenever they incubate a successful startup or unicorn, they were quite happy to share those gains by listing these companies instead of making private transactions. So the level of behavior, corporate behavior and governance behavior was positive. And by that time, we had a greater track record where the Tencent management team were delivering consistently good, fair transactions that we felt were for the benefit of all shareholders. At that point in time, the concentration of the revenue streams were far more diversified as well. So it was no longer just earning a lot of money from its gaming revenues, but it also made money from its entertainment platforms, its messaging platform, its investee incubating companies, as well as its payment platforms. So they are diversified effectively, and we felt that gave us more comfort that it was a well put together and sustainable business model.
Excellent, thank you. Next question: would you ever buy a company that scored badly on your 3 ESG criteria, but one that you thought could improve and that you would have the influence to improve it?
Yeah, it is possible, but the key thing here is that it would need to have the desire to improve. It would need to show us that it was taking its ESG commitments as responsibilities seriously. And depending on what they said to us in our meetings with them, we need to see either a commitment of resource in terms of hiring, or a commitment of deliverables in terms of publishing ESG reports, or commitment of process where we get to understand how they're adding ESG procedures into their business to make sure that they do better work, cleaner or greener work. But yes, it is possible. And I think that's really important. Here's a hypothetical scenario. There are a lot of coal producers in China, coal electric company producers in China. And as you can imagine, they would score very poorly by ESG measures anyway. But the potential for them to do good is really quite unusual, because by improving the efficiencies of their input energy or their input resources, And by cleaning their captive capacity, which is not small, they could see a huge, they could actually effect quite a huge improvement over the next 10, 20 years. And that would be an exciting change to see that and to walk through with that and partner them as investors as they go on that journey.
Okay, thank you. Next question. Given what's happened with government clampdowns in various sectors in China, do you think that that market is now riskier than it was?
I think it's as risky as it's always been. I think the tricky part is that for a long time, it had not misbehaved for a long time. And I think people were getting comfortable with what some of these companies how these companies were free to operate and had the flexibility to operate their business models to the way they liked it. But there's always, the Chinese government has always been very paternalistic and very prescriptive about how the businesses or the capital markets work. As long as they do not see a social ill, they will let it run for a while. But we have seen a clampdown. The current clampdown is primarily grabbing the headlines are the online business. But if you go back a few years, you would have seen that they've been pushing for improvements within their energy companies as well, because the environmental strain of industrialization over the last 3-4 decades have had a huge toll on the poor environmental quality in many of its cities. So I think the level of regulatory intervention has been a bit more intense during the last 18 months. But I think that level of intensity is inbred within the Chinese market, where you do have a very centralized government. They will tend to be quite blunt in some of the way they implement policies. But that means that when we do look at Chinese companies, we need to try and understand the ESG factors more, so that we can see whether that is that business model or that company is at risk of being targeted or not. I don't think it makes Tencent or Baba uninvestable, but I think you do need to be careful about how much you have in Tencent and Baba, and you need to be careful about how much you're willing to pay for valuations or for those types of companies.
Super, thank you. Next question. Should we in the West be thinking about whether goods manufactured in Asia have come from factories powered by coal and actively avoiding these?
I think it's important to know where your supplies are coming from, and I think it's important to know where the components of energy that's being consumed. But I think it's also difficult to get a free flow. It's difficult to get a free flow of all to get transparency for all the information that you need to come to a good conclusion as well. I think you need to be wary of companies that are positioned that way. But the better ones among them would already have plans in place to evolve the way that they procure, the way that they get energy, and the way they get supplied by their own ecosystems as well. And I don't have a quick, easy, simple answer for that, because it is also very good to say that we don't want a part of that type of business or that sector, but there also must be reasonable alternatives to supply the world economy with some of these goods and services as well. So it is questions that we need to ask, but You know, to give you a more accurate answer, we need to delve into stock-specific examples and understand the limitations of information in some of these cases.
Thank you. Next question. Is corruption still a problem in India?
It's a problem everywhere. I would say corruption is a problem everywhere, and I think I think with the levels of improvements in capital markets across the region, it gets more and more difficult to engage in corrupt practices, and it's a function of quite a few things. It's a function of investor awareness. It's a function for the quality of journalism or investigative reporting in a particular country. It's a function of the political culture of a country as well. It's also a function of the civil service and the gap between the private and the public sector, the gap between the haves and the have-nots. So I perceive, I've been investing in India or looking at the Indian market for about 20 years. I perceive a difference, but I'm not naive enough to think that that it no longer exists. And what we can do is that we can look for signs in the companies that we invest in, you know, and understand the sectors that we want to invest in. There are ways to do that. For example, I would say that the telecoms industry is probably less corrupt than it used to be because of the huge crackdown about 6 to 8 years back, where a telecoms minister was put in jail, spectrum fees were redistributed, licenses were cancelled, some companies went bust. So on a case-by-case basis or on a sector-by-sector basis, you can see improvement, but I wouldn't say it's all moving in the right direction, but I would say that most of it is moving in the right direction.
Excellent. Thank you, Adrian. That was a super talk. We're now out of time. I'm conscious there was probably a couple of questions we didn't get to, so perhaps we pass those over and perhaps you can answer those on our website later. I'm now going to hand over to Joe Bound-Froud of AVI Global Investors to talk to us about AVI Global.